All right, in this crazy interest rate frenzied environment of ours, we thought now could be a good time to get back to some basics. Today, grading growth with a unique academic approach. Squawk School, here to take us through his equations, and you face the CNBC, Prof Mohanram, professor at Columbia Business School. Prof, great to have you with us, and you've got a grading system here for hot growth stocks. Let's just pick one here that passed your system. I guess, I don't know if getting an A is the right way to describe it, but Microsoft. How did you get Microsoft to a check, that's a buy?
I have this grading system which uses three broad categories of signals. You know, we all know that growth stocks have incredibly high valuations, and most of them don't live up to the very high valuations that they have. So I asked myself, which are the firms that are likely to justify this extremely high valuation that they have? So the three categories of signals I looked at are, you know, what are your basic fundamentals like? You know, how is your earnings, how is your profitability with respect to your peers? The second set of signals I looked at was, how good is this firm's track record? You know, we all know that these firms can have extremely high current performance, but which is the firm which is likely to maintain its performance? And then finally, which are the firms which are investing in the future? So doing things like R&D, capital expenditures, advertising, things which might hurt current earnings but lead to much better performance in the long run. So based on that, you know, the reason why I had Microsoft rated very high is Microsoft is a firm which is doing all of the above. It's extremely profitable. It also has a tremendously good track record, and it's investing in the future. It does continue to have high R&D and so on and so forth.
Now, why does Cisco score so well?
Cisco the same way, because, you know, if you look at Cisco's performance, and by performance I'm referring to the actual financial performance, you know, its financial ratios.
Right.
It has reasonably steady track record of growth, of profitability, as well as it's doing the kinds of things you would expect a firm to do. Now, one thing to keep in mind in this strategy is this strategy actually works much better for identifying losers than winners, because remember, these stocks are already incredibly highly valued. So finding real winners or diamonds in the rough is unlikely to be the case. On the other hand, there are many firms which get extremely high valuation because of the hype surrounding growth stocks. So what the strategy does is it tries to focus on those stocks which get extremely low ratings. So if you look at the stocks which I have in my low G-score category, you know, I had the stock Sirius Satellite Radio, for instance, which has then subsequently done pretty badly. I also had Ameritrade. Both these stocks rated a 2 on my 8-point scale.
Yeah.
But it doesn't work all the time. I also had the stock called Millicom, which did reasonably well in spite of being a low rating. But this could be a stock which is overvalued right now, and who knows, it might do badly going forward.
Now, before we go, it's my understanding you're right now working on a paper that asks whether managers manipulate earnings around large option exercises in an attempt to inflate their compensation. Is there anything about that paper that you can share with us at this stage?
Absolutely. Actually, that's a paper which I published a couple of years ago, and along with my co-author Ellie Bartov at NYU. And what we basically found was that when managers have large option exercises, the year before then they start manipulating their earnings through accruals, you know, so making their earnings look much better than they are. And then subsequently these earnings reverse. And we find evidence that the stock market doesn't take this into account, and everybody, including, you know, financial analysts, get fooled. So if you track large option exercises by managers, you can be reasonably sure that there's going to be a price reversal following that.
Very interesting. All right, it certainly looks like it works more times than it doesn't work. Partha, thanks a lot for joining us.
You're very welcome. Thanks.